All right, welcome to another explainer. Today, we're really rolling up our sleeves and putting on our expert investment analyst hats because we are running the ultimate stress test. We're taking Bristow Group, a massive global aviation player currently trading at exactly $42.35 a share, and we're throwing it straight into the gauntlet. We're going to apply the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and then cap the whole thing off with some modern quantitative models. We really want to see if this stock can survive the scrutiny. So let's just dive right in. Welcome to all our focused learners out there. If you're looking for a direct, fundamental breakdown without all the fluff, you're definitely in the right place. Bristow Group operates this incredibly diverse fleet of 214 aircraft across 15 different countries. They're literally the leading global provider of vertical flight solutions, meaning they move people and provide critical services for offshore energy and government entities. Today, we're dissecting their financials to find out what this business is actually truly worth. Okay, let's quickly walk through our roadmap. We'll start with a company snapshot, then apply our GRU lenses, Buffett, Lynch, and Graham, run some alternative models, and finally, deliver the ultimate verdict. Section 1. Company Snapshot, a transformational year. To really understand the stock, we have to understand how they bring in the cash, right? Looking at the first quarter of 2026, 65% of their revenue comes from offshore energy services. That's essentially transporting workers out to rigs. Now, historically, that's a fairly cyclical business. But then you have this 27% chunk for government services. This is the stuff like running the search and rescue operations for the UK and Ireland. That revenue is incredibly stable, and as we'll see, it's really the bedrock of their entire financial profile. Moving on to Section 2, the Buffett lens, moats and margin of safety. So, what would Warren Buffett think? Well, we know he wants a protective moat, manageable debt, and honest management. And Bristow has a massive moat. They operate the two largest commercial search and rescue contracts in the entire world. S&P notes that 85% of that government revenue is completely fixed. That is a textbook, Buffett-approved protective moat, giving them huge long-term cash flow visibility. On the debt side, it's very manageable, with a debt-to-equity ratio of 0.85, and they're actively targeting $500 million in gross debt. Return on equity, 10.87%, which is genuinely solid for a capital-heavy aviation business. Plus, management is acting exactly like owners, reinstating dividends and buying back shares. Buffett loves that. Another thing Buffett absolutely loves is owner earnings, which we can approximate using free cash flow. Because Bristow has already completed the heavy capital spending needed for those new government contracts, S&P is projecting they'll generate between $150 and $175 million in free cash flow in 2026 alone. At a $1.25 billion market cap, that means they meet Buffett's cash generation criteria very, very comfortably. All right, Section 3, the Lynch lens, categorize and compare. If we channel Peter Lynch for a second, we have to categorize the stock first. Bristow is really a hybrid, a turnaround and an asset play. It's a turnaround because they are successfully emerging from this period of really heavy capital expenditure into a highly profitable transformational year where they're just aggressively shedding debt. And it's an asset play because, well, they have a massive global fleet of 214 aircraft. That provides a very hard floor of tangible, real-world value. Now let's look at the math Lynch would obsess over. A PEG ratio under 1.0 is pretty much the holy grail for Peter Lynch. It signals the stock is undervalued compared to its growth. Bristow's trailing PE ratio is a relatively low 11.04. Meanwhile, their adjusted EBITDA is projected to grow by roughly 24%, hitting a midpoint of $310 million in 2026. If we take that PE of 11 and divide it by the growth rate of 24, we get an implied PEG ratio of roughly 0.46. Under the Lynch lens, this is practically screaming that the stock is undervalued relative to its earnings trajectory. And you might be wondering, what's actually driving that massive growth? Well, S&P Global Ratings hit the nail on the head. They point out that in the offshore energy sector, the combination of limited helicopter supply and stable demand has pumped up rates by an average of 25%. This gives Bristow some serious pricing power. As their older contracts renew, a full quarter of their fleet is stepping up to this leading-edge pricing. Lynch would absolutely love the dynamics of this setup. Moving to Section 4, the Graham lens, the conservative gauntlet. Benjamin Graham's entire investing philosophy basically rests on one single concept, margin of safety. You must buy a security at a significant discount to its intrinsic value. As we run these next numbers, remember our anchor here. Bristow's current stock price is $42.35. We need to see if the hardcore math actually provides a cushion beneath that price. Let's put them through Graham's defensive investor checklist. Adequate size, they're well over $1 billion, so pass. Strong financials, their current ratio is 2.15, meaning their short-term assets easily cover their liabilities. Earnings stability is confirmed with positive net income, and they just reinstated a quarterly dividend. Finally, for valuations, Graham wants the PE multiplied by price to book to be under 22.5. Bristow's comes in at 13.02. So yeah, it clears the entire hurdle with flying colors.
But here is the really crucial point, the actual intrinsic value calculation. Graham's legendary formula is the square root of 22.5 multiplied by earnings per share multiplied by book value per share. Using the source's trailing 12-month EPS of $3.04 and their book value per share of $36.17, we can calculate the absolute rock-bottom baseline value of this company.
And the result is $49.74. Let's really contextualize this for a second. Even under Graham's punishingly conservative math, which literally ignores all future growth and looks purely at backward-looking trailing fundamentals, the company is still worth almost $50 a share. At today's price of $42.35, Bristow offers a 15% margin of safety. Graham would undoubtedly be interested. Section 5. DCF and Alternative Models. Let's look at the modern quant approach. Okay, let's build a discounted cash flow base case. We're going to be totally transparent about our assumptions here. We're using a base year free cash flow of $162.5 million, which is the exact midpoint of the S&P projection. Now, because the sources don't provide a precise weighted average cost of capital, we assumed a 9% weighted average cost of capital. We chose 9% specifically to reflect the heavy capital intensity of aviation, blending their 6.75% coupon debt with an equity risk premium. And finally, we assumed a very standard 3% perpetual terminal growth rate. So how does this build out in a sensitivity table? Well, our base case, that 9% WACC and 3% growth, yields a fair value of $65 per share. But look closely at the extremes. Even if we assume a punishing 10% cost of capital and an anemic 2% growth rate, the fair value is still $48.10. At a current price of $42.35, the market is pricing in extremely pessimistic scenarios that honestly just don't align with Bristow's rapidly rising cash flows. And this brilliantly illustrates the story when we look at alternative multiples. If we value Bristow purely on historical trailing PE multiples against its peers, you get a conservative $38.50. But, and this is a big but, if you apply an EV to EBITDA model which actually factors in enterprise value and their debt against their 2026 guidance midpoint of $310 million, the fair value shoots all the way up to $74.50. So the historical view says hold, but the forward-looking operational reality is screaming buy. Finally, Section 6, Synthesis and Final Verdict. Let's bring it all together. Here is the final board. Warren Buffett's criteria, fueled by that massive government moat and huge owner earnings, triggers a buy in the mid-50s. Peter Lynch's PEG ratio analysis points to a valuation well over $80, so a definitive buy there. Benjamin Graham's ultra-strict intrinsic formula gives a 15% margin of safety at $49.74. Another buy. Our DCF base case lands at $65. Across the board, almost every single guru and model points to Bristow being significantly undervalued right now at $42.35. But as expert analysts, we always have to weigh the whole picture impartially. The strengths are absolutely undeniable. Government search and rescue monopolies, 25% higher offshore pricing rates, aggressive debt reduction, and a transition into massive free cash flow. But what about the risks? Well, their financials are definitely exposed to foreign exchange volatility between the dollar, pound, and euro. And importantly, while the government side is rock solid, the offshore energy side still relies on cyclical hydrocarbon extraction budgets. We are looking purely at the financial data from our sources here, and that cyclicality is a very real factor to keep in mind. So we want to leave you with this final thought. We've run the numbers, we've checked the moats, and we've calculated the margins of safety. At $42.35, is Bristow's transformational year already fully priced in by the market, or is this vertical flight business ready for a massive liftoff? Thank you so much for diving into this explainer with us. Keep analyzing, keep learning, and we'll see you next time.